So good morning, everyone. Hopefully my mic's on. Yeah? It is? I'm assuming it's on.
I can hear you.
You can hear me? Okay, great. There we go. Okay. So I'm joined this morning by my two guests, Adiza Tiani, who is Director of Marketing at Token Technology, a US-based fintech company. Now essentially based in the UK for the last 2 years, Adiza?
So we came to the UK last year.
Okay, excellent. And John Egan, who's Senior Director head of Strategy at the Anthemis Group, and I've just learnt has an economist background.
Yeah. So I'm of the opinion that if I keep saying the same thing over and over again, eventually it'll be right.
Brilliant. All right, so we're going to be tackling the topic of Brexit and its impact on fintech. So in preparation for this morning, I did a little bit of lazy research yesterday. It didn't take me long. I think within a half an hour period, I just picked up this stream of headlines. Just to kind of break the ice here, the impact of Brexit. Cancer patients could suffer treatment delays because of Brexit, according to the Metro. Brexit will drive up supermarket prices, says ex-Sainsbury boss. Aussie PM wants a speedy free trade with the deal with the UK, according to Sky News. Article 50, uncertainty, the order of the day for the UK SME fraternity. And Brexit woes see UK firms curtail investment plans. So that was within a 20-minute period yesterday. But of course, we are talking about the impact on financial services, and of course, as a segment, more specifically, fintech. So according to a recent PwC survey, the potential estimation and impact of relocating services because of impact could see the UK suffering, the GDP suffering a 0.4% decline within the next 3 years. And if we look at the passporting implication, the numbers vary greatly, but it averages out to about 100,000 job losses potentially over the next 3 years. There is also fairly negative sentiment in terms of the ability or certainly the agility of other European partners to do work with the UK, given the fact that any bilateral agreements potentially expose their own competitiveness and essentially safety net of working directly with the UK versus being protected within the EU. However, on the positive side, despite the impact of passporting, I think there is the general feeling that the transition of any UK-based headquarter for any established financial services institution is unlikely. And once we get over the initial shock of a Brexit, once Article 50 is formally triggered and things are set in motion, I think the overall feeling is that the impact for the UK would be far less onerous than for our EU compatriots. Bearing in mind that the EU, of course, is a non-static entity from a political, economic perspective. So, if I turn to you now, Adiza, I'd like to really explore with you, you work for a company now, but your career prior to joining Token allowed you to have a quite considerable amount of visibility of fintech companies exploring the UK, specifically London, as their base for a number of reasons. And that was pretty recent, right? So what observations, if any, have you had from that in terms of the general feeling? Was the talk of Brexit something that actually created some friction for companies? What were their main concerns? Any thoughts on that?
So just for some context for the audience, I currently work for a fintech company called Token, which is focused on open banking and APIs in banking, and a piece of legislation called PSD2 across Europe. But previously, I spent the last 3.5 years actually as part of the founding team of Level 39 in Canary Wharf, and it was my job to recruit technology companies into the UK and to make London their home. Before that, I was in a edtech startup. And I actually rolled out the payment system at Level 39, so I have a tech background. And one of the key things that companies have been sort of thinking about is the ability to hire talent. So when I joined Token in December, we were 3 people in London, and now we are 15 people in London. So the ability for us as a company to hire talent that can speak different languages, that has familiarity with local markets is very important. We spend a lot of our time on a plane across Europe. I think I've seen more of Europe in the last 8 months than I have ever before. And I think that one of the key things for fintech companies is the ability to attract talent to their businesses and to also attract investment. We closed our Series A in April, and we had pan-European money. We had money from the UK, so Octopus Ventures, money from Sweden, EQT Ventures, and also money from Finland. And we have a base in London, and we are headquartered in San Francisco. So for us and for the fintech companies that I know, for the entrepreneurs that I talk to all the time, the ability to attract investment and to attract talent, because once you have that investment, you need to use it to hire great people and great talent. And in order to do that, you need to be able to plan for the future. And so it's still the key priority. Even though Brexit is happening, we are still looking to hire, expand, and we as a company, as Token, as a US company from Silicon Valley, have actually been expanding. I think one of the things that, for us, the regulations that we look at are to do with PSD2, and in the UK, there is another set of things that are going on within open banking, and those two bits of regulation, the people that are working on them are looking to have parallel tracks so that it doesn't impact, businesses are still able to take a pan-European approach. That is quite a forward-looking way of looking at a piece of regulation that impacts a lot of fintech companies across Europe. The regulation means that banks have to open up to third parties, so banks have to start using, they have to allow third parties to access account information, and we advocate a methodology where you use APIs. And so that methodology is happening in different parts of Europe all the time, and it's happening in the UK. So for us as a business, as long as the UK regulation and the EU regulation are parallel, which actually on the ground, there is a lot of parallels happening, and we are trying to be as unified as possible. Is it hard? It is hard. But the professionals in the industry are trying to work out a way to make sure that we can all move forward as an industry, and to also work with government. We have engaged with the Open Banking Working Group here in the UK, and when we are in different regions, we try to engage with the local regional banking associations and fintech associations, but we're a small team. We don't have huge lobbying. We don't have someone that deals with lobbying or public policy in that way. And our focus is to actually grow our business. So it is tough, but talent and investment are the two things that are really important for us.
Great. So in true fintech spirit, right, the ability, as most entrepreneurs navigate through points of friction. And so it sounds like, all right, that you are doing that, all right? You are thinking ahead, you are navigating despite scarce resource, And that's what you've got to do. I mean, essentially, you're a pan-European business, and a lot of American businesses that base themselves in London or in the UK generally springboard, right? So that's heartening. Adisa, you did mention your investment process, and well done, by the way, in terms of a number of co-investors you have there, so things are looking up for you. Great. Which is essentially a segue for John. John, looking at the track record of Anthemis, highly diversified, been around for a number of years, and really, I think the Anthemis strategy has been really pioneering, I have to say, in terms of fintech, simply because of the length of the time that Anthemis has been investing in the segment, in the sector. But also what Anthemis has, to the outside world, done extremely well, has really kind of brought into the fold the trust of a number of CVCs, corporate investors, right? So there's an advisory component to the Anthemis strategy. I'd like your opinion in terms of, what are those corporate partners, co-investors thinking about, debating with you in terms of their investment strategy and protection, moving forward in terms of where they go to next, and, what does Europe hold for an investment play?
Sure. Good morning, folks. My name is John Egan. As introduced, I lead the strategy practice at Anthemis Group. Some of you may be familiar with Anthemis Group. We're a large fintech-specific investor. We've been around for a long time. We're probably the most successful investor in the space. I lead a strategy practice. That means I deal with incumbents, banks, insurers, asset managers, etc., on a daily basis. My background is as an economist, and a large part of my job is to distill large geopolitical risk down to what it means for finance as an industry. That's everything from Japan's economic policy to Iranian referendum last month and the Turkish referendum the month before to US elections, and 25% of my time, I'd say, is spent on Brexit, and has been for the last number of years with governments around Europe and regulators and businesses as well, whether they be clients or otherwise. I should state for the record as well that my position on Brexit, I'm very bearish on Brexit. I think it's a cataclysmic event in the evolution of the British economy. I'm on record as saying that a number of times, and I can go into a couple of reasons why I think that to be the case. One of the frustrations I have with the commentary around Brexit is the false equivalency that is continuously created about challenges and opportunities. There are monumental challenges associated with Brexit, extraordinary challenges. Opportunities are minuscule. I'm sure that if you went to Bosnia in the 90s, you would have found opportunities, but I guarantee you the challenges would have been far more significant. And that's the kind of situation that the press and I suppose the media coverage in general, and one of the startling phrase that keeps on getting pushed out again is, let's make Brexit a success. This is the Juncker leak from the meeting a month and a half ago. Let's make Brexit a success. Brexit is not going to be a success. There is a chance that Britain can maintain a particular trajectory that is less or is reductive or is -1 to that of its European neighbours, and I can go into some of the reasons why and how we're likely to see it manifest in finance. A couple of things. First of all, for most people in this room have been done a disservice by politicians in the UK, and that it wasn't effectively communicated what Brexit actually means and the complexity of actually removing a constituent nation from the European Union. There are, at the beginning of this conversation, there are 32 decentralized agencies in Europe, everything from the Food Authority in Parma to the Medicines Authority to the Banking Authority to the Chemicals Authority to the Aviation Authority. And in March 29, 2019, when you get up the next day, March 30th, what you will find is there is no real guarantee that when you walk into a shop and you buy bread, there's no carcinogenics in that bread. When you walk into a pharmacy to collect medicine, there is no guarantee that those meds are not fake. When you get on a plane, you want to take off to travel for business, whatever else, there is no mechanism through which that plane can safely take off and land in another jurisdiction. That is the situation that Britain finds itself in, or the United Kingdom finds itself in right now. And the complexity of negotiating that exit is such that it would take somewhere in the region of 15 to 20 years for a nation with a mature trade negotiating team to actually manage. That is not the case in the UK. One other point I would make before I begin to clarify what the investment space is going to look like, is that another frustration from my side, being an active participant in this conversation for quite a while, is the idea or the notion that the United Kingdom will be able to manage independent trade negotiations with other jurisdictions. That's folly. That is a nonsense argument. If I use the example of, if Adiza and I own hardware stores, and Adiza is 10 times larger than my hardware store, and she wants to negotiate with our supplier, am I going to be able to get a better deal than she is, even though she's 10 times larger than I am? Of course not. In fact, because she's 10 times larger, she may be able to dictate the terms on which I can negotiate a deal with that supplier. And if it's a supplier that we don't actually have access yet, if it is a region in the world that there is no European deal with, by negotiating a deal with Britain, they will effectively cap or limit their opportunity to negotiate a deal with the European Union. So the European Union will dictate British trade negotiations for the next 20 years as a consequence of that. So I am of the opinion, as you may have told at this point, or you may be getting some sense of my bearish outlook on Brexit generally, this is not a good thing. And the sooner we begin to realise that, the better. And certainly as a European citizen living in Britain, I'm constantly aware of it. So what does it mean for investment? What does it mean for finance generally? Well, I would say that you probably have told from my accent, I'm Irish, and I've relatively good relationships with a number of people in the Irish government and the IDA. And there are 12 large British-based institutions that have already secured leases in Dublin. Now, that does not mean they're going to move wholesale from the UK to Dublin or Frankfurt or Amsterdam or wherever it happens to be. The question is about strategic expansion. The question is about growth in the UK over time. So the next point that decision comes up to expand a particular team, it will likely not happen in London. It will happen somewhere else around Europe. And that is a concern, because that begins to deteriorate or degrade the single productive industry in the UK over the next 10 or 15 years. And that results in a productivity concern, which in turn results in a national debt concern, which in turn results in an interest rate and inflation concern as well. All these things begin to connect together. Finance is the shining light of British industry, and the European Union have worked for 10 years since the crash to place Britain at the very forefront of European finance. And the regulation that Adiza referred to, PSD2, in conjunction with GDPR, MiFID II, IFRS 9, and the Capital Markets Union ultimately as well, were all constituted in order to put the UK at the very forefront of finance in Britain, or in Europe. That's no longer going to be the case. So everybody is reeling from this. What does it mean from an investment perspective? We're a global investor. We have investments in the UK, but half of our investments are in the US as well. We're quite comfortable in the UK, but I would say the majority of our team are actually international as well. Will that have an effect? It likely will. How will it manifest? It's unclear, because the government have been unable to string 5 words together coherently on what Brexit actually means for people in the UK post March 29, 2019. So it's very unclear, so we can opine on it. But the one thing, as the date gets closer and closer, you begin to realise that the absolute opacity and ambiguity surrounding this particular topic can only be a bad thing. We are now working on the assumption that things will be fixed and things will be sorted out, but it would take about 5 years to negotiate a deal that secured safe relocation of pets across Europe. Before the European Union, it took a truck driver 70 forms in approximately 8 hours to cross one border into the other. As an Irish person, I'm particularly concerned about the border between Northern Ireland and the South, and that is a quagmire of a problem that's not going to be fixed anytime soon. So it is very difficult to talk about Brexit's ramifications in finance without actually considering the broader geopolitical impact as well. I'm going to stop there because I've monologued for a while, and I'm pretty sure I've secured that position too.
Yeah, that's pretty clear. But John, I have to come back. Is it too early to tell, one, whether there's been downward pressure on investment rounds, valuations? And secondly, is it too early to tell whether European investors are gaining ground, potentially as being more attractive to those raising finance than UK investors? Any thoughts on that?
So early signals are EIF have stopped investments in the UK, largest European investor. You can also see that a number of VCs, existing VCs who are looking to raise second funds, have failed in doing so or have had to reduce the size of those funds. So I think the indicators are quite clear so far that there is already an impact. You couple that with the fact that Europe in the first quarter of this year grew by about 0.5%, the UK was going by 0.2%, debt's going up again. All the wrong signals are there for a strong VC environment. It's not going to crumble, but what it will do is it will seriously hamper the growth of really global firms beginning in the UK. It'll be easy to get seed round funding, it'll be easy to get A round funding, but if you're looking at further rounds, we don't have the mature debt markets and we don't have the mature, we will no longer have the mature equity markets, I think, to support that. It may not be the case in Europe, but the UK is probably 5 to 10 years more advanced than Europe when it comes to VC anyway. And there's a talent question like Adiz referred to as well.
And
so the talent question, I guess, is key. I mean, you know, that kind of deal flow, that natural deal flow movement to the UK is all fueled by growth opportunity, expansion opportunity, as you say, and skills, right?
So I think that the UK tech economy is fueled also by the bigger tech companies having offices in London, and that talent being able to then move into the startups, and whether or not the startups are able to afford those salaries is due to whether or not they're able to raise enough investment to pay great talent to join their team. And so it is still happening. I know multiple people that have still moved to London as a city to join global startups here over the last year. Has it been harder? I think that the people that I know that have moved to London have moved because the companies that they're joining, like DeepMind, Google, Apple, Twitter, are still great companies, and they have offices here in London. I think that for us as a US company and as a British Ghanaian working in a US company in London, I think it's important to remember that talent is still very global. So the best talent is happy to move, and the best talent in Europe will continue to move if the opportunity is really strong. And having British investors such as Octopus to have supported us, but having investors from the Nordics as well as a US company just shows the global nature. And I think that sometimes with this debate, we forget that we are already in a very globalized world, and London, specific tech community, and I saw it at Level 39 every single day, the companies that were applying to be at Level 39 were from all over the world. They were not just British companies. In London, we have companies from everywhere. And I think that it's very short-sighted to, so does Token define as a British company? We have a British UK office, and we have, I think, over 14 nationalities, languages, spoken in our team, and so we are a global company, and I think that it's really important that talent makes a decision on what company they decide to join. And if here in London and across the UK, there are amazing tech hubs across the UK, Manchester, Edinburgh. Edinburgh is great for fintech. A lot of people don't know, but Edinburgh has great fintech companies coming out of there. And I think it's really important to keep thinking about this in a globalized way, because regardless of what happens, we are still globalized. And talent wants to work for company. Tech talent is specific in wanting to work for companies that do have more of a global mindset.
Yeah.
I know an engineer that moved from Google in California to Google in London as he wanted to work in another city. He has worked in Japan, he has worked in Canada, he is Canadian, he's worked in America, now he wants to work in London. And the talent will continue to move to the best places and the best opportunities. And London's strength is the fact that she is a global city. I am a Londoner, I was born here, therefore I will always think it's great. But its diversity is one of the key things that will help us navigate the Brexit situation that we are currently in.
I totally agree with you in terms of the fluidity of entrepreneurial skills. But I would like to pose a question to you, John, in terms of the established financial services arena. I mean, there's league boards every other week in terms of which center in Europe is going to attract the top bankers, right? And there's always this kind of skew between incentive versus lifestyle. That surely has an impact on the broader ecosystem, because 80% of fintech is B2B relevant and is innately connected to the broader financial services community. I don't know if that's something you have a comment on, but there is that, I think there is a departure in terms of the fluidity of talent when you look at the maturity of these two segments.
Yeah, sure. And London's irreplaceable in a European context. London is effectively, New York and San Francisco twinned together in one place. And in terms of as an attractive place to live, it's also very, very difficult to compete with. There's nowhere in Europe that you would look at as a global hub with the traditional trade routes that London has. It's as easy to live in, to commute to exist in, and that's a very challenging thing. So for a lot of these large incumbents, not that will determine their decision-making process, but it will certainly determine the decision-making process of a lot of the executives and what they want to do and where they want to base themselves. Now, whether they become domiciled in a different country and continue to work from a UK office, we may see that. But I think that you can see to date the large incumbents have struggled with a changing geopolitical environment over the last couple of years, in part because they're still struggling to deal with the 2008 crisis. They're still suffering from really significant cost-income pressure. As a consequence of that, they're struggling with this kind of technological evolution as well, and then the introduction of PSD2 kind of ensured that they were going to remain in stasis until that began to manifest itself. So one of the reasons I think that the banks and insurers were very quiet in the lead up to Brexit was because there was a lack of clarity about how they saw it actually manifesting, and it seems to be quite reactive at this point as well.
Yep.
My own view on what will happen, I think it'll take us 20 years before we can genuinely look back and say, well, that was the likely impact of Brexit. And if in 20 years' time we look around and we see that Lloyds are based in Amsterdam and Barclays are now based in Dublin or something else, then we'll get a sense of it. But again, the whole Brexit argument has been framed in this kind of instant response perspective, and that's not the case. These are huge organizations, and the dynamics of a global economy will be such that things may swing back a different direction over time as well. So I'm sure we'll see them distribute and spread more of their operations around Europe. There's certain businesses that have to move, like Euro trading. It's $2 trillion a year that has to leave the UK. So any of the kind of Euro-denominated trading activity will probably, and that will leave a dent in the city banking infrastructure. But that's not, for the big four banks, they've still got a core retail base who they need to service. The UK is still a big country, so it'll take time for that to manifest.
Yep. All right, I'd like to open up to questions to the floor, but I'd like to ask you both the same question. Essentially in a paragraph, real kind of, here and now view and sentiment for fintech. If we had two windows to essentially accelerate the entire Brexit journey, which, as you say, is going to unfold over potentially 15 to 20, what is your sentiment in terms of its impact on fintech?
I think that the clarification on talent and immigration, I worked on this list called the Shortage Occupation List about 2 years ago, and working on that to add 4 jobs to this list took more than 18 months. Just for 4 jobs to be added to this list. So I think that the fintech sector the bigger fintechs in London need to engage with government on immigration policy that allows talent to move freely as need be, as it takes decades to nurture talent. And I think that the smart investors will continue to co-invest in a pan-European and in a global way. And so we have investors from 3 different countries, and our seed investors are US-based. So I think that it's very important for Brexit for us to continue to encourage a globalized view of the world. But I would say that I am a child of a migrants in London, and my dad is a computer science and maths from Ghana. So, of course, I would say that. And I think that for companies, fintech companies specifically, after seeing over 1,000 fintech companies in my time at Level 39, and also seeing fintech companies today, as entrepreneurs still don't believe I've left, and still want advice on how they can do lots of different things, I think that we also need to reassure our neighbours. We need to reassure our neighbours that this is still a great place to do business, to live, and to make sure we make the diplomatic effort to do the soft power as well.
Really good point, actually. Yeah, our relationship with Europe.
So Europe as a region is the most avant-garde financial region in the world at this point. The US is 10 or 15 years behind. China is moving its own direction. Africa's gone mobile. So if you break the industry in Europe down to 4 pillars, and you look at the money supply dictated by monetary policy, the ECB, then you got the second layer, which is the money multiplier, being the banks. Third layer being the infrastructure rails, custodian networks, and payment infrastructure, and the fourth pillar being products and services. What we've seen in fintech to date is predominantly a fourth layer, the products and service layer, the surface layer. And I think we'll continue to see that, and that's not going to slow down because the ease of access, regardless of Brexit, we should see quite a considerable amount of it. As Europe gets a little bit more difficult for US companies to access over time as well, because of a lot of that open banking regulation, we may see there being advantageous to being situated in Europe as a fintech company as well. I think the area that I'm really kind of curious about is that second layer, the infrastructure and rails layer. You need to have significant infrastructural capacity to be active there. So we've seen Apple, Facebook, Google, Amazon, etc. all make moves to get in there because it doesn't require licensing and it effectively allows you to dictate what consumers buy. And that's where we'll see the most movement in fintech generally, with a lot of propositions being built on top of that infrastructure that they built.
Very good. Thank you both. Right. So I'd like to open up to the floor. Can I? No, we don't. Oh dear. Okay. All right. Well, audience will have to come and hound Adiza and John after. So anyway, thank you very much. Hope you enjoyed that. It was a delight to have my guests. Thank you, John. Thank you, Adiza.
Thank you.